Hello everyone, welcome to another Reuters Events webinar. Today we'll be talking about ESG in the midst of COVID-19. We have an excellent panel today, hosted by Boston Consulting Group's Veronica Chow and featuring Jessica Strine of Sustainable Governance Partners, Sasha Sandan of Legal and General Investment Management, Xavier Desmadril of HSBC Global Asset Management, and Dean Frankel of BCG as well. So this webinar is part of a series of webinars and content that Reuters Events is putting together in the ESG space. We'll be having a lot more over the coming weeks, months, focusing on the ESG conversation and how we can support the various challenges therein. So please stay tuned for that. So without further ado, I'll hand over to Veronica and start the webinar.
Thank you very much, Dominic. Hello, everyone. Thank you so much for joining us today. My name is Veronica Chow. I'm a partner and director with BCG, focused on sustainable investing and social impact. We work with clients around the world to both develop and implement sustainable investing and ESG strategies that not only contribute to their business objectives, but also to a better and more sustainable world. We've collaborated today with Reuters to bring a conversation to you about how this crisis will affect the momentum and direction of trends in ESG and sustainable investing. As many of you who work and observe this space may recall, 2020 was meant to be the breakthrough year in this area. As recently as in January at Davos, ESG, sustainability, sustainable investing dominated most conversations. And yet here we are now. We find ourselves in the midst of a global pandemic. Over 3 million people sickened. Over 200,000 people have lost their lives. Healthcare workers are courageously continuing their daily fight, and essential workers are putting their lives on the line just to keep basic supply chains operating. We're also now understanding the impacts of bringing our global economy to a standstill. Both the US and the EU have recently released economic data that shows some of the worst downturns since the Great Financial Recession, and both have warned that the worst is yet to come. So as these impacts are becoming more understood, both investors and companies alike are working through the very real issue of how to adjust their approach to ESG in this market context. How should ESG priorities be adjusted in this as we weather the storm? But then conversely, how could ESG be part of the solution? How can companies and investors alike use ESG and sustainable investing levers to not only accelerate recovery, but position both themselves and the society that we live in to be much more resilient in the long term? There are certainly some very encouraging signs that both companies and investors alike are continuing to prioritize both ESG and sustainability, even in the midst of this context. Asset managers like Schroders and BlackRock, Legal and General, as we have on the line, HSBC, have all released commentary indicating how important this is. My own colleagues at BCG, we are bringing a very strong ESG lens into all of our work across sectors with clients. In fact, we've developed sector-specific lenses of levers that executives can deploy that will not only accelerate their recovery from this crisis, but also position their business models for resiliency as we move forward. But there are some real challenges that we have to confront. So for example, how will some of these major fiscal packages that governments are releasing affect their ability to finance important contributions to their climate change agendas going forward? So there's a real mix of trends. So to explore these questions, I have a truly distinguished panel. I'm joined today by Xavier Desmadril, who is the Global Head of Research at HSBC. I have Jessica Strine, the Managing Partner and CEO of Sustainable Governance Partners. Sasha Sandan, who is the Director of Investment Stewardship at Legal and General Investment Management. And then my colleague, Dean Frankel, who is a Managing Director and Partner with BCG's Asset Management practice. The way we'd like to flow today's conversation is we've organized thoughts on 5 topics, and we'll work through all 5, keeping the conversation very fluid throughout. We'll start by just first unpacking the trends. What are we seeing about how ESG is playing out in this market context? And what are some of the implications that we're seeing in the early days about how it's affecting agendas? We'll explore what themes may or may not be rising in prominence and which may be shifting as a result of how materiality itself might be shifting within industries. And then we'll hear both what are the implications for companies and how they ought to be engaging with their investors, and conversely, what should investors be doing with their own sustainable investing strategies as they move forward. Now, as it stands right now, we have over 500 of you on the line, and we'd love to hear from you as well. And so throughout the conversation, we'll be introducing polls to hear a pulse check of how each of you are thinking about these topics. We also have a live chat box, which I can monitor as we go through, and I'll be pulling some of your questions and introducing them into the panel as well. So let's keep this very, very lively, very interactive. So on that note, why don't we jump into it and just start by understanding the trends, and perhaps Dominic, could we start with the first poll? So we'd love to hear from you, all of you on the line. To what extent do you believe that a company's ESG performance thus far is affecting their ability to weather the storm? So please select one of these options. Great. And then as you're selecting, perhaps I'll pose the question now, start to Xavier Demadril. Xavier, HSBC has published research precisely on this question, where you've looked at over 600 global public companies that have demonstrated that companies with stronger ESG ratings have, at least in these early days, withstood some of the market volatility in February and March. So we'd just love to hear, how are you and your team thinking about this, and what are some of the insights that you uncovered in that research? Xavier?
Okay, sorry, I was on mute. Well, thank you, Veronica. Well, it's true that, and the poll here clearly shows that people will tend to agree with the fact that COVID and ESG performance are indeed linked, or at the least that the COVID crisis acts as an accelerator of the fact that ESG performance is recognized as something which is actually sustainable. And for instance, you were referring to the fact that HSBC has published recently a couple of surveys dealing with this topic, and some of them are revealed that since the start of the crisis, and basically we could say that it started last December, companies with strong ESG credential, with a high quality in terms of ESG performance, have actually outperformed global markets, and this quite significantly. And if I'm looking at the various surveys published, the consensus is around 400 basis points. And it doesn't mean that those companies have been positive in absolute terms, of course, but still they have proved more resilient. Interestingly, what has been seen on the short term is also very much valid on the longer term, which would tend to demonstrate that companies with high ESG credential are better suited to withdraw the crisis and the various cycles which the market is experiencing. And if we look at the longer term, for instance, there has been a survey published covering a much longer period of time, coming from 2007 to 2020. And of course, in 2007, between 2007 and 2020, we experienced also the Lehman's collapse, the financial meltdown. And it's interesting to see that companies with high ESG credential have not only outperformed, but they have also shown the lower level of volatility, which means that over the long run, such companies have shown their ability to deliver better risk-adjusted returns. And I think that's important for the investors. And this has been clearly revealed by the crisis. And where does this come from? It's simply because there's no much broader agreement regarding the fact that it's not only about satisfying the shareholders, it's also about satisfying the stakeholders. And if you're able to satisfy both, or at least the three P's, people, planet, profit, and you know that this is long-standing concept of triple bottom line, you are again you are showing more robustness, you are, let's say, more sustainable, and in the end, you should deliver better performances for the investors over the mid to long term.
Terrific. Terrific. Thank you. The BCG's forthcoming Global Asset Management report will show that in 2019, alternatives, passive products, as well as ESG were winners. What are some of the early highlights that you're seeing and some of the trends that we will be sharing?
Sure, and hello to everyone on the webinar today. But let me start by giving a bit of context to the industry, because I think it's important, and as I say, it does explain why we're seeing what we're seeing with regard to ESG. So, as you mentioned, we publish an annual survey of around 150 firms, and this year, like others, what we've seen is that the asset management industry has been really propped up by market growth. So, since firms charge fees based on assets under management, and that's been going up over time, they've been artificially higher. Revenues have been artificially higher than they should or they could have been for some years. And actually, the more worrying thing is that we've seen costs as an industry rise faster than revenue by about 2%. And then when you add on the COVID market correction we saw only a few weeks ago, it doesn't really paint a pretty picture for the industry. So what that means, and then kind of the link to ESG, is that there'll be a continued flight to quality, and that to try and outperform and to drive inflows, firms have to invest, and they have to make sure that what they're doing, particularly those active asset managers, are investing properly. They understand everything that they are investing in, and if they want to try and beat the market, they need to do that, or essentially give up. So what we see is the trend to more alternative asset classes, to outperforming stocks, and also the data shows quite rapid growth to passive products. And then within each of those trends, you really do see the implications or the flows on ESG funds. So we've seen over the last 3 months quite amazing data at how on each of the main asset classes, equities, fixed income, mutual funds, and both ETF, ESG funds have seen greater inflows than their counterparts. And when we think about what's expected to happen going forward, it really, I think, even highlights the need for, in a COVID environment, this is going to continue. And that as firms really think about how they can outperform, it's going to be through better scrutiny of the underlying companies and of these ESG factors. So I would expect the trend and the shift towards ESG products to continue and even to accelerate.
Any other panelists, any comments on this before we move to the next topic?
Hi, it's Sasha here. The only thing I would add to that is I think there's definitely been a shift between, as Dean quite rightly says, to ESG products, and about being more mainstream and being back into the investment process. I think most managers are integrating this into their investment process, and you just have to look at the environment we're in now. There's lots of discussion, even in the last few weeks. A lot of our clients are asking us about tax, and tax being, our company's been paying their tax for the last few years. Now they want governments to bail them out. Debates like that, and I think those sort of social issues are certainly going to be higher up the agenda, and that's going to affect everyone's investments rather than just specific ESG products.
Actually, that's a great segue into our next topic. So perhaps, Dom, if we can get the poll going. What we'd like to explore now is what does this all mean for ESG agendas? So I'd love to hear from the audience. To what extent do you think this crisis will create either headwinds, tailwinds, or potentially both for both companies and investors? And as you're answering, perhaps I'll tee up the question, another one for Xavier. Xavier, HSBC has also released some commentary on how the implications for this pandemic could create structural shifts in the economy. Some that might further progress on key goals, for example, environmental, maybe we're all traveling less, but some, quite frankly, that could hinder progress towards important agendas, notably around income inequality, poverty, hunger, these sorts of topics. So could you comment about further how this crisis will change how both investors and companies alike pursue these priorities?
Yeah, sure. As Sasha was mentioning, we are currently in an era where it's not only about having a bunch of specialized, but obviously niche SRI or ESG products. I think we are now entering an era where this is set to be integrated. And I think that, again, the COVID-19 pandemic is acting an accelerator. And why is that? Simply because some criteria, some indicators have shown their importance. And I'm essentially thinking about the social criteria. And you are right, Veronica, I think there are some major changes. And I think this seminar we're having this afternoon is a perfect illustration. We are all learning to work from home, and this in various manners. And my hunch tells me this is there to stay. So that's a major change. And this has actually many consequences. Typically, think about it. If people work more from home, will we need as much workspace as we did in the very recent past? I don't think so. That's a very clear change. So, and also if we work from home, and again, this seminar is a perfect illustration of this matter of fact, we need more technology. So it's very likely that the enablers, actually the guys developing the technology enabling this to happen, will also benefit from the crisis. But more structurally, I think if we look on the other side of the pond, I mean on the other side of the Atlantic, you will see that the US unemployment, and I hope Jessica won't deny me, is going to reach all-time high. I was looking the other day at the stats regarding the Great Depression, and I think that the US unemployment peaked at some 25% between 1929 and 1930. It's very likely we will go beyond that. Temporarily, very likely, but it's very likely we will go beyond that. Another interesting stat is also the importance of the gig economy. You know, this mass of temporary workers or people working on very short-term contracts, etc., etc. It's representing more or less 1/3 of the total workforce, and more or less 1/3 of the companies are let's say, involved in this gig economy. So is this going to change going forward? Maybe, maybe not. But I think there will be a clearer framework, because if the gig economy is generating poverty, and unfortunately this is very likely, there will be much more emphasis on themes such as social protection, the fact that people should have paid leaves, etc., etc. And I think this is there to stay. And if the company shows its inability to deal adequately with these topics, I think it should be detrimental to its reputation. And this is very likely something which will get priced in, and we are back to this, let's say, ESG integration theme. So I think that's a major trend. So some sectors could benefit. Overall, social dimensions are going to be more embedded into the investment thinking and to evaluation. These are clearly the changes I would see going forward.
Absolutely. And maybe Jessica, I'll pull you in here, because your firm has also been looking at this, the S in particular, and how it's going to shift in prominence for investors. So you want to comment on some of the work that you've been doing to really understand what investors are thinking on the S in ESG? Can't hear you. There we go.
Can you hear me now?
There we go.
Oh, good. I think that the hand of God was muting me. I didn't want to hear any more on this topic. thanks to our coordinators keeping us all silent until it's our turn, rightly. But yeah, our firm has done a deep dive review of really what investors are looking for and what issuers are doing, particularly as it pertains to human capital management, which increasingly is the first topic under the S that we're all talking about and considering. And it's a topic where I think you've seen ESG concepts become real tangible decisions and actions in this environment. So investors are looking for companies to talk about employee health and safety, the handling of layoffs, how rehiring and retraining will happen, how they're supporting the front line, especially essential workers in this environment. Also looking at the top of the house at compensation and wanting to see equitable treatment of the workforce as well as the executive suite, and looking for disclosure on all of this. So whereas I think coming into this year, we had been spending probably the most significant time on the E, environmental concerns, and I'm sure we'll talk later about how those certainly haven't taken a back seat. We're seeing so much focus on the S, and within that, not just the culture and diversity components, but also the very important human capital management considerations.
Absolutely. Any of our other panelists want to chime in on this topic of the increasingly S? Great. Well, certainly the work that we're doing with our clients is front and center, all of the ways that BCG has been supporting its clients in the reboot and recovery. We've been putting, employees and health and safety truly front and center, and certainly we believe that as we move forward, this should hopefully stick, right, as just part of how we do business going forward.
Veronica, I'll just add a couple of points. I mean, one, I think if you look at the media and we just look at what's being written, everyone is trying to look at this, which companies are doing the right things. And I think we should also be very cognizant that we should be positive on companies that are doing the right thing and supporting them. And I know Xavier as well has been doing a lot of work on this, but we speak to many chairmen, and we have done in the last few weeks, about you put your shareholders second if you need to. Stakeholder primacy is absolutely the most important thing. If you can't afford your dividend, make sure you look after your employees, because this is absolutely crucial. And when you do that, explain how you're doing that, because that's quite important. Companies that have made mistakes already, and I don't mean to be naming them, but you've seen some companies in Germany like Adidas where they took government money and didn't want to pay their rent for a week, but that only was a week, and they changed that because that came from the electorate or it came from the media, but they did change that policy. And I think it's really important that this is already happening. This is not just because of investor pressure. This is, I think, a societal change.
Mm-hmm. And Sasha, I might add on, if I'm not muted, it was very interesting, I think, this morning to see that with Shell's announcement that for the first time in 45 years, they've cut their dividend. Their CEO, Ben van Beurden, posted his address recapping the quarter. And I was looking at the timeline along the bottom of the screen, and at the 15-second mark, he highlighted the importance of communities, colleagues, and customers far in advance of any discussion of this historic decision to cut the dividend. Again, first time in 45 years. So I think that investors are communicating, as are you, to public companies that you do want to hear about stakeholder outcomes. And I think we're seeing many public companies respond to that.
Terrific. Why don't we head to the next poll, because it explores this theme even deeper, which is on how we anticipate materiality might shift by industry. So we'd love to hear, from those on the line, to what extent do you foresee material behavior changes by consumers, businesses, et cetera, that will actually shift the materiality of ESG factors, either across the economy or within certain industries? Great, and as you're answering, perhaps I'll tee up the question to Sasha. So Sasha, Legal & General just released their active ownership report. Actually really enjoyed reading it. It was a terrific publication. And in it, you cite some of the priorities For your ESG engagements in 2020, you list climate change, ESG transparency, the challenge of overboarding, financial inequality, privacy, and you also list healthcare, including the pricing of pharmaceuticals. So we'd just love to hear, to what extent do you or have you shifted some of the prioritization of themes, and to what extent do you anticipate that there will be meaningful shifts in materiality of key factors as you move forward?
Hi. Yeah, so this is our 9th annual report on ESG. And I think just to be, as a $1 trillion asset manager, we have an absolutely privileged position, but also a hugely influential position where we can try and help in these areas. And I think these things have been going on for a long time, and this is absolutely unprecedented times. And I don't want to be trying to make anything specific over this. This is just totally, we care about our clients' money, we care about their financial materiality. And you just touched on one, overboarding, which is how many boards can one director physically do and still be a very good, effective board member? Well, we've been pushing when there have been people who have been on the boards of 7 companies and saying that that's not good enough. You can't do that, because what happens when 2 or 3 of them have a problem? What we didn't expect was when all 7 may have a problem and you've got 7 emergency board meetings. How can you physically even read the papers, yet alone turn up for the meetings when they're on the same day? So we've been we voted against over 776 directors last year on the fact that they've got too many boards. And they go to, you always say to you, but they're very intelligent people. And we say, it's not about their intelligence, nothing personal about them. Could they just do 5 positions? That would be nice. And so these kinds of things have been worrying for a long time. One of the topics that we talked about, tax transparency is a very important topic. And we've been voting on resolutions to try and get in to understand where people's tax are, because it is important that we know that people are paying the taxes, the fair taxes. And I think that's something that's going to come back. And then you mentioned income inequality. Absolutely. If I just take the UK for a moment, it's been quite hard to try and get some of the companies to pay the living wage, which is the bare minimum that you can live on in your region. I think that kind of debate has already started to move, but sadly, because of these kinds of crises, I think that will be the debate that people will talk about, not just what executive pay has been. So I think these kinds of topics, the social topics, as Jessica has mentioned, will become higher, but I don't think climate change will go away. I absolutely do not think that will go away, and I think it will be a very important topic. You've just mentioned Shell. Shell only a week ago in the middle of this talked about net zero carbon by 2050. It didn't shirk it in the middle of this crisis. It still pushed that target. It's still going to be judged on it. Its pay is going to be judged on it now. And I think climate change is something that all of our clients, and Xavier's mentioned it before, is not going to go away. And it is the topic that we talked about the most in the last year, because that's the kind of thing that our clients wanted us to do. But this does shine a light on it, absolutely.
Perhaps two quick follow-ups on that. So one is, one of the conundrums, if you will, on the S has been, what are the right sorts of things to disclose? And I would say, compared to the environmental topics, the standards for disclosing and sharing information on social performance are, I would say, less well, there's less consensus, if you will. So we'd just love to hear your thoughts about, from all 4 of you,
okay,
as we move towards wanting to engage more on the S topics, what will that imply for the types of things that companies will need to disclose, and or the types of capabilities that investors will need to analyze that kind of data?
So just to start with, I mean, it's already in our report, but so before this tragedy, but, political lobbying, whether it's in pharmaceuticals and pricing of pharmaceuticals, whether it's in tobacco, whether it's in lobbying on oil and gas, not saying that climate change may not be man-made, and yet saying in the annual shareholder report to its investors that we care passionately, naming and shaming companies that are doing things like that. I think so. Political lobbying and transparency will be one, and then employee rights, labour rights. You can just tell from the UN Global Compact, you can get a list of companies that have violated labour rights. Well, we've tried to name and shame them, because I think that is just, it's not the things that you want in your client investments. And so therefore there are some of these topics are there, but they're not always easy to talk about. But I think they will be topics that we carry on, and I know others will agree with that, hopefully.
although to your point, Veronica, if I may, I must admit that we finance people love data. And we have got lots of data when it comes to environmental issue. We can measure the carbon footprint, carbon intensity, and so on and so forth, measure the 2 degrees alignment. It's still that more difficult when it comes to social issues. Is job creation the right criteria? Sometimes it is, sometimes it's not. It's very actually difficult to say, I'm going to rank companies because we create lots of jobs. Is retaining people a good criterion? On the principle, yes, but it's very difficult though to make the connection between the social behavior of a company and its share price. This is something we are struggling with for the time being. However, there are some interesting initiatives, like for instance, the ICMA social bond principles, which are kind of pointing you to the things which are of a true relevance. And I would like also to mention a collaborative engagement we have recently signed up to, which has been led by ICCR, Interfaith Center for Corporate Responsibility. It's a UK initiative, basically. And it's really about pushing companies to do the bare minimum, which is about having paid leaves, having, let's say, having some financial prudence principles, caring about health and safety. All of this seems very basic, but you soon discover that not everybody is doing this bare minimum. And this is why I think it's, as Sasha mentioned, naming and shaming, I think it makes sense. We think it's important to push to carry forward the social agenda to contacting the company. And for instance, something which has been positive for the environment has been to have a TCFD and to have subsequently engagement campaigns pushing companies to publish reports to disclose what they are doing. I think we are now entering an era where the same thing should happen for the social fields.
So maybe I'll just add on, expand a little, and share that what we're hearing from investors is that while the data is by no means sorted, while we have some reporting parameters, particularly under SASB, for some of the key S issues, both on the social capital and the human capital side, it does seem that there is a growing consensus around the tangibility, the shift from concept to real decision and action orientation. Whereas back 2019 and for years before, there were elements of the E, of the environmental concerns that we could measure and set targets around. A lot of the data on the S side is self-reported, subjective, and some might think a bit fluffy. Frankly, I think much of it still is, but because investors are focusing on it, I expect that there will be further development of more objective measures, more standardized output, because there will be more scrutiny. And the reason for that is the sheer tangibility of the human capital asset in this environment, the risk to it, and the opportunity long term to shepherd it through this environment. The way that we're looking at it is, or we're hearing investors are thinking about this both on the top half of the PE multiple as well as the bottom. On the side of the market price of a security, they're thinking about quality, brand, the public perception of a company and how that can translate to the market's willingness to pay for a certain company over another. And then on the denominator side, obviously, there are things like employee retention, turnover, all those frictional costs, which we could certainly debate offline, but generally speaking, are viewed to be costs and opportunities to a company and something that you do want to manage, and ultimately that will impact EPS.
Veronica, sorry, Dean, after you.
I was going to say, I just to completely agree, and going back to one of the earlier points about ESG becoming more mainstream. For me, the first step is transparency, and then it becomes consistency. So, the ability to have this in everyone's scoring in a consistent manner, and for me, it's just a question of time rather than a question of if. So, all of these factors just become part of the course.
Yeah.
And all I was going to say was, my team, I've got a fabulous team, but I think a lot of this is common sense. When you're a large owner and you get to meet the chairman and they say they care about their employees, but the executives get 40% pension contributions and the staff get 5%, then you start to wonder what they mean by they care about their employees as much as anyone else. Or when their churn rate is twice the industry average. There is enough data out there. It's not perfect and we need more, and I think we are getting that. But there are definitely enough touch points that we can start to see which companies are really walking the walk and the ones that just put platitudes out there.
Great. Let me throw in some questions from the audience here. Let's build on the climate change question, and maybe Sasha, I'll start with you on this one. There's a question from one of our participants. Do you think that COVID-19 will impact the scope and implementation of the European Green Deal? And if so, then how? So maybe Sasha, Xavier, our two Europeans on the line, if you have any perspectives on that.
Well, I'm not an expert on the European, but I would say absolutely. If you look at our client demand, and we have thousands and millions of retail customers, they are demanding that we still care about this. And I know the EU, it's one of their biggest priorities. So I do not think this will go away in any way, shape or form. Some companies might have a different focus because of the time we're in, and you can imagine airlines as being a perfect example of that, and we might need to give them a bit more time. But does climate change affect the planet? Is it going to still affect our material resources? Is it going to affect our clients' assets? Yes, it is, and therefore this won't really affect it for very long.
What I would like to add to that, and of course we are on a very similar page, is that at worst, this environmental agenda will be slightly delayed. It's still center stage, but it has now to share the center stage with the social issues, as we have discussed. But as there is currently maybe a difficulty to finance everything, to finance the economic recovery, to finance all, and to support all the social needs which will soon occur in the coming weeks, in the coming months, not to mention the coming years, it's maybe just slightly delayed. But there has been this week an event called the Petersberg Climate Dialogue. And the Petersberg Climate Dialogue is gathering some distinguished people like Mrs. Merkel, Dominic Raab, etc., and a bunch of environment minister. There are 30 of them, and it was hosted by the German environment minister. And there has been discussion regarding this European Green Deal. And you know, this Green Deal is very ambitious. It's about reaching zero net carbon by 2050, which is tough, which is a tough call. And people are saying, oh, that's marvelous. Currently, the CO2 emissions are so low that we could meet the target. But this is not there to stay, which means you still need to have a clear strategy to reduce going forward those CO2 emissions. And one of the key takeaways from the Petersberg conference was that almost everybody was in agreement. Of course, this was a very European conversation, but you have Mr. Merkel, Mr. Johnson also intervene, and so on and so forth. And everybody was saying there needs to be a clear economic recovery plan, but it needs to be green, meaning that people should push forward the creation of green jobs. They should push forward the development of renewables. They should push forward the development of hydrogen-produced electricity, things like that. You know, very concrete actions. And so it has to be a recovery plan, this for sure. That's the absolute priority, but this has to be green or it won't be. And that was more or less the conclusion of the Petersberg Climate Dialogue, which took place this week. Great.
So for the participants on the line, the questions are really starting to flow in now, so fabulous. Please keep it up. I'm going to group a few together. So here's a group for Sasha and Jessica. It really builds on some of the commentary you had about climate change and Shell in particular. So there's one around Sasha, how do you really determine the extent to which these oil companies are simply paying lip service to climate questions, i.e. setting targets 50 years from now, net zero by 30 years? Like, how do we detect what does true commitment look like, particularly in this moment? And then Jessica, along similar lines, to what extent would you attribute the cut in dividend to actually just the fall in oil prices, right? So how should we kind of pick apart what's driving what? So we'd love to hear both of your reflections on that.
Okay. I think you asked me first, but I'm happy for Jessica to get.
Yeah.
Okay. So easy one. We have to be cynical in this job. It's very easy to put out a target in 30 years' time and go, hey, we're all done. It's fine. Of course, that's not the right. So when we look at companies and we look at the oil and gas sector, so as you specifically asked me, we rank the companies, the largest companies in the world in the oil and gas sector, to what they're doing. So their political lobbying is a perfect example. And Shell and BP as examples have now named that they've now launched their campaign on which things they spend money on. And they've got rid of some of the lobby groups that they used to spend money on. So they're actually taking money away from groups that have stopped some of the EU Green Deal and things like that. So the actions are the things that matter rather than a policy. Secondly, Shell now, you asked me about Shell, but we've now got Shell, Ben van Beurden, the CEO, to put targets linked to his pay. So even shorter term targets for the next 3 to 5 years are now linked to his pay packet. So not just the 2050 target. Now that took a while and that took a lot of negotiating, but that's the kind of thing that hopefully a large investor should try and do to make it more linked to it. But yes, there are companies, and ExxonMobil be one that we've named and said is not doing enough work, that is still lobbying, is still spending huge amounts of money in this area, and I think he's not doing a good job. So we have to say that there are differences between the companies that are leading in this area and the laggards. And I think you have to name that as a large investor.
And Sasha, you stole my thunder. I think we have a lot of, ironically, about what would seem like two different questions, but actually really, in our view, come all the way to the top of the house, to the board, right? And so in really trying to suss out whether an action is lip service or just breaking the mercy to the oil price, certainly we want to examine what's happening from the board on down, including executive compensation, including how they compare to peers. And we see some pretty interesting differences, particularly among the majors. And you mentioned Exxon. It's quite instructive, I think, to compare companies like Exxon and Chevron alongside one another, and to look at their boards, right? To look at the composition of people and the areas of expertise and the amount of process orientation they have toward ESG topics broadly, but even more specifically, of course, climate transition risk. Compensation also quite important. You're seeing very different paths pursued by these companies. But taking it back, Veronica, to your initial question, of course, in addition to the coronavirus tragedy or pandemic, there's an oil price war happening and a huge demand shock as a result of the pandemic. This is a perfect storm of storms and a tragedy in and of itself in terms of capital allocation and planning for many of these companies. And so they are responding as creatively and flexibly as they can. But again, back to my earlier comment, I think that comparing what different companies are doing and what they're saying, one versus another, Europeans and Americans within each region, how the majors are behaving, is quite instructive in really evaluating how long-term oriented they are about these problems.
Veronica, just one thing to add. Just I know we've got a diverse set of attendees on the call, but when thinking about where to allocate your own money in terms of your own funds, you can apply those same, or I would encourage you to apply those same filters to the asset managers. So you do have a lot of asset managers paying lip service to some of the criteria, but not to big up LGIM and HSBC too much, but really standing behind what you're saying, being on the panels like this goes to show people going the extra mile. And when you're investing or when you're asking questions, ask questions about the extent to which fund manager compensation is linked to some of these criteria, because I think the leading players in the industry really do this, and that does and will differentiate them going forward.
Terrific. Why don't we go to the next poll, because it ties in nicely to some of the other questions that are coming through. And Jessica, we're going to come to you next. So we originally formulated this question to tee up, what are investors' expectations right now of companies, particularly as we recently had earnings seasons. The next one is approaching. So Jessica, would really welcome to hear, what are you hearing from investors about what the expectations are of companies as they think through their ESG agendas versus the many other pressures that they're facing? And then one of the attendees on the line has actually asked you to unpack the extent to which we might be hearing different things from European investors versus American investors versus investors in other parts of the world. So in your conversations, have you noted differences in how investors might approach this question?
Okay, so I'll try to get to all of that because it's a lot.
Yeah, it is. Yeah.
And I think we can. Broadly speaking, though, against the backdrop of what many are rightly calling a black swan set of circumstances, we're looking at all the feedback that we're gathering from investors and thinking this is, in terms of investment process and philosophy and the shifts therein, maybe it's more of like a beige swan, right? Investors are not changing their stripes. They're not adjusting, the beliefs that they have about long-term intrinsic value, whether they prefer earnings compounders, high growers, and what value drivers tend to generate those outputs. So broadly speaking, the things that we've heard historically, the way that investors are evaluating companies haven't shifted wholesale. And in a similar vein, the types of things that we hear about in Europe and the US are also trending along the same sets of imperatives that we've heard about historically. I think this group probably is well aware that European investors are far further kind of out front on many of these issues, much more willing to lean in, particularly on the E and the S, whereas I think the G has sort of been settled for a while, and we think really since the financial crisis, if not longer, we've tended to be kind of pulled forward in America by our European counterparts. But broadly speaking, again, we don't see investors really changing their stripes. They're still incorporating, traditional material ESG concerns into both the proxy voting work of the investment house as well as the alpha quest on the active management or portfolio management side of the house. We are seeing some traditional portfolio management teams incorporate ESG concepts into their investment framework. And some are calling them ESG and saying we now integrate, and some are just doing the same work that we've been talking about, conducting a much more fulsome evaluation of these trade-offs between near-term decisions and long-term intrinsic value drivers. Looking at, again, some of those questions about long-term employee engagement and workforce management, looking at the risks to communities, as well as the operational and financial risks of plant closures and other near-term decisions. So while these are new issues or the issues of the moment, and they're very pressing, we think that they still feed the same long-term focus on intrinsic value growth. So hopefully that's not a disappointing answer, and certainly that's not to make light of how important these near-term issues are, but hopefully also encouraging to know that investors are not completely shifting their methodologies.
Great. Why don't we, just keeping an eye on the time, let's just do the final poll, which is, okay, so what does this all mean for the asset management and broader kind of investor space? We could just flip to that, and then Sasha, I'll tee you up. So Sasha, you've written in your active ownership report that going forward, greenwashing actually is will be one of the biggest challenges we'll have to grapple with. And I think in light of all the trends we've discussed on this call, that there will be potentially even more in some cases, good and well-intentioned efforts to package things as sustainable. And then you mentioned there might be some more cynical players as well. So we'd just love to hear your perspective of how can investors authentically and courageously continue to do this work at this moment in time.
Okay, so back to Dean's point on transparency and greenwashing. Let's call it what it is, greenwashing. It is obviously ESG has become a much more exciting topic, and therefore commercially there's a lot of people that think they can then sell funds that are ESG compliant. What does that mean? You should be thinking about this for all your investments. It should be part of the investment process. And so it is part of our job. If it's our job to try and get transparency, as we talked about for companies, then surely we have to hold the light to ourselves. What are our voting policies? Do we put our votes online? Do we abstain? Where do we sit in the organization? Luckily, I've been very fortunate being a director of the firm, of $1 trillion firm for 9 years. So I hopefully annoy them as well as please them, that we try and get them to hold the same standard, so I can talk to companies and not say that it's different, but my CEO gets paid or any of the other things. I think it's very important. And I do think there are many questions you can ask, and very easy ones. Why is it that investors aren't naming some of the worst companies in this? What's so wrong with it? It's not that hard to work it out. We've just heard from others how they do it. It's not that difficult. Why do people abstain on big issues? Why aren't they voting on political lobbying? Why aren't they talking about tax? Maybe it's because their own house is worried about talking about tax. You have to walk the walk, and I think this is very easy, and it's very important that we get that, because what I don't want, and I do this not because of Legal and General in any way, shape or form, I would love some of our good peers who we work very closely on lots of things, I would like them to be having more money so that they could then push the companies. What we don't want is a climate change fund where they don't do anything on the mainstream assets, because that will make the companies delighted, because then they don't have to do anything. And I think these are the sorts of things, or splitting the vote, letting each fund manager vote their own way, not worrying about it in certain portfolios. That is not the way that a big asset manager should do. So there's some of the examples we can use, and there's enough independent reports from PRI, Share Action, and I know BCG and stuff do work on ranking people and seeing who are really walking the walk. So I don't think it's that difficult, but we need to step up, because otherwise it's going to be embarrassing that the whole world talks on ESG, but we haven't done enough.
Good. Well, we have 5 minutes left, so maybe I'll just do a tour de table of Xavier, Dean, Jessica. Any additional words of advice and or closing thoughts?
I would just jump. Sorry, go ahead, Xavier.
Well, sorry. Well, I think Sasha is absolutely right. I think the days of greenwashing are certainly over. We cannot tolerate this on the company side, and we cannot tolerate this for ourselves. I would like also to say that, to me, the recent emergence, and due to the crisis, unfortunately, of yes, is, I think, reshaping the way we consider stock valuation and stock pricing. There has been many discussions regarding climate scenarios and the impact of this scenario, and especially in the Paris Agreement context, which scenario is going to influence the stock valuations and how. I think it's now time to roll up the sleeves and really consider whether these criteria have to be included, because they have clearly an influence. And I would like to highlight a recent example, and it's interesting to see what has happened as Amazon. There are strikes in France, and we are champions when it comes to strikes, but there are also strikes in the US, which is way more uncommon. And where do they come from? It's due to the fact people fear to go working in the warehouses, because they think that the health and safety procedures are not, let's say, strong enough to prevent them from the negative consequences of COVID-19. So I think it to make us wonder that this can trigger production disruptions, which can affect the turnover, and this has a clear, let's say, influence on the financials of a company. So here we've got a correction, we've got, let's say, a connection which is to be made, and as Dean was saying, We don't have all the criteria as of yet enabling us to do that, to make this connection, but I think it will come anytime soon.
Perfect. I
would just add that, thinking about factoring all of these issues into an investment process really, I think should compel us all to be thinking about investment time horizons. This is an opportunity perhaps to recalibrate. A lot of active managers are incentivized primarily on 1-year numbers, if not 3-year numbers, generally not as heavily weighted in the 5-year plus time horizon. And as we've seen with prior crises and economic recoveries, these things take a lot of time, and investors would be probably well placed to be thinking on multiple year time horizons about investment returns. That's much more appropriate when we're talking about some of these ESG issues, right? We can take a longer term view and really work collaboratively or engage constructively with a portfolio company on these types of issues. If we're able to get past the circle, the rat race of quarterly earnings and shorter term incentive periods. So for investors, for public companies, for intermediaries, this seems like a very important opportunity, this environment to talk about investment time horizons.
Great. And Dean, any closing thoughts?
Yeah, just to agree with that. It makes me laugh. I spoke to someone the other day who said, look, if all the financial models were truly factoring in all the ESG criteria, we would have maybe not seen such a large market correction, or at least accounted for some of these factors. And I think it does, Jessica's point, paint to a need to have longer term, different assessment criteria for some of these drivers, and then have drive for different conversations going forward. And I really do believe, and it's one of the reasons we don't kind of call it out a lot in our asset management research. This is core to the asset management industry, to the analysis of any stock and any company. And it's just, a crisis like this really highlights the importance of some of these factors and the need to be even more efficient and more effective in the measurement of them.
I would just say that in this tragic times, it shows us when we reflect that we need to be brave. And being brave, as from an investor point of view, is to keep pushing on the areas that are not always the areas that you thought that you would get away with, or you think that are easy to do. But these are the biggest issues. The amount of people that have said that, oh, that's not that important, or is it financially material, as we've discussed? Do it. This is the time to be brave and to do it, and do it on all your investments, not just on a subset of your investments.
Great. Well, we've reached time, and I would love to continue. This has just been such a terrific conversation, and there are even more questions continuing to come in. So to all of you who are on the line, thank you. It's been terrific to have you all. To the panelists, what a fantastic conversation. My opening remarks painted a appropriate but admittedly bleak picture of the moment we're in, and yet I certainly found coming out of this conversation, I'm quite hopeful in the resolve of both those of you who have spoken, but the institutions that you represent, and more broadly, the kind of leadership we're seeing out there by investors and corporates alike, who are really using this opportunity to rethink some long-held assumptions and to take that much more forward-looking view. So on that note, let me say to everyone, thank you. Wish you all a wonderful day. Thank you to Reuters for hosting us, and looking forward to continuing to engage with many of you on these very important topics.
Thank you.
Thank you, Veronica. Thank you, everyone. That was a really great discussion, and Veronica, very well chaired as well. Thank you for keeping to time very excellently, and all the questions that came in. I know that we were rather bombarding you with lots of insights there. So thank you to everyone. Next month, we'll be moving on to look at ESG data, looking at how we can validate, how we can ensure that we're getting reliable and accurate ESG data, and make sure that it's comparable and usable. So stay tuned for that, and we'll be in touch with more insights from the community. Thanks, guys.
Thank you.
Bye.